Welcome, everyone. Thank you so much for joining our webinar. Those of you who have joined us in the past, you might have noticed a slight rebrand. We were formerly Pronto Income Tax. We're now Pronto Advisors. And I think that just aligns a lot better with everything that we're doing nowadays and everything that we offer our clients. More of an advisory role since we work with them, not just to understand the past, right, tax filing, but the future, how do we plan and how do we prepare for the future? So we advise our clients, and that's kind of what differentiates us, aside from the fact that we're very hyper specialized in real estate and tend to work with folks who invest in real estate, aside from possibly other businesses. So jumping right into it, we're going to talk today about why real estate investors need cost segregation. Go a little bit about what is cost segregation, why do you need it, how does it work, what are the some of the practical discussions. We'll have an example at the end with some numbers, so to kind of bring it back home to does this make sense, when does it make sense. So we'll be going through that this afternoon. For logistics, if you have any questions, feel free to drop them in the chat, and we'll at the end we'll go through questions and answers with anything that you might have. All right, so kicking off, what cost segregation does? What is it? Actually, what is cost segregation? And really, cost segregation allocates eligible costs into shorter depreciation categories to accelerate tax deductions. And I say shorter depreciation categories, shorter in timing. So there's this opportunity to take things that would have generally been depreciated over the life of real estate, right? So normally when you depreciate an item, you go over the full life. If it's real estate, it's a long life, right? 27 and a half if it's residential, or 39 years if it's commercial. So if you take that up and slice it, kind of that standard depreciation, thinking about commercial, 39 slices, you have 39 slices over 39 years of the same exact depreciation over that time period. But the reality is that many of these structures already contain items that can be depreciated in a shorter tax time frame by the IRS rules. So there's personal property, 5 to 7 years, depending on what it is. There's land improvements that can be done in 15 years. So what that allows you to do is to actually take the useful life and depreciate these items over their useful life, which will allow you to depreciate them earlier on. So years 1 through 5, if you look at the cost segregation pizza pie analogy on the right, you have these bigger pizza pies. So you're just basically getting earlier tax benefits. And since the useful life of these items tends to be for a shorter time period, you take that depreciation again once you replace that. So thinking about appliances, that's an easy one. You look at washers, dryers, if you have an apartment complex, washers, dryers, refrigerators, etc. So the useful life, right? 5 years, you depreciate over 5 years, and let's say you don't buy a new set till year 8 or 9. You can now redepreciate those items over that time period. And we'll talk about some of the other challenges with, as we kind of go through this of not doing cost segregation. So, all right. So who typically selects this strategy? Cost segregation is really often used by investors. If you invest in real estate and you have properties that have been placed into service in the last 10 years, you're looking to find ways to potentially save some money now, right? If you have a higher income today, there's some opportunities there. There's also, if you're current owner, and you're planning some renovations or capital improvement, that's a great time because you actually know the cost of these items that you're going to depreciate. And so we'll go through in a little bit. There's some of the opportunity to accelerate that even into year 1, thanks to bonus depreciation. So cost segregation, which is what we're talking about today, can be used in conjunction with bonus depreciation to bring that into year 1. And we'll talk a little bit about that as well. Portfolios, so with some other opportunities as well, portfolios preparing for refinance or expansion, and if you're reassessing your tax strategy for the years ahead, you're thinking of making potentially an accounting change or finding some other opportunity. That's a great time to do so. So when you do cost segregation, you generally work with a third party that produces this engineering report that the IRS has committed, that they will then go and produce based on what is actually in the structure. They will review, they will gather data about the building, about the property. They will have engineering-based asset classifications, and they will, and I think I missed this on the previous one, and I apologize. Cost segregation does not increase the size of what you can actually depreciate. It still stays the same size. So they're going to look at it and just say, this is how it actually is structured. Your land costs stays the same. The land value stays the same, but now how do we reallocate this based on these categories? So they look at it and say, well, you have this many light bulbs, you have these many appliances, you have this much in landscaping, and these are things that you can accelerate.
Not there.
Right. The other thing that they'll do is that they will produce this report. They'll get this report, and with this, we could now depreciate these items in a shorter time frame, so that when we do the tax filing. So we use this one for planning, right? We look at the plan of what is your tax bill going to be, and now the fact that we're able to accelerate or depreciate a larger amount, we will be able to say with certainty that you will have a lower tax bill this year, and so that will allow you a better cash flow this year. And so then at the end of all of this planning, right? So we're doing all this work to plan, to figure out what is actually we're able to segregate out and depreciate in an accelerated fashion because of the useful life. And then now we can then at the end of it file your taxes for the prior year, that's just the formality, right? At that point, we've already identified what is the tax savings, what is the additional depreciation. It's just sort of the turning in your homework, so to speak. At that point, you've done all your homework. Do note that with cost segregation studies, there are two different types depending on the property. There's a non-site visit, which is generally a much less expensive cost segregation study, and there are on-site engineering studies that will obviously cost more because they will have to send an engineer out to the site in order to conduct this. So I mentioned cash flow impact. So, year one, versus a straight line depreciation, again, those 39 slices, if we're talking about commercial, now you have these bigger slices in the first 5, 7, 15 years. You're going to have 2 to 4x increase in depreciation. And as we'll go through an example, sometimes even more. That is without tacking on bonus depreciation. This is just cost segregation. So I try not to confuse folks. I'll mention it sprinkled throughout, but their bonus depreciation will let you just take those 5 years and bring it into year one. Those 7 years, bring it into year one. So lots of exciting things there. There's a federal tax reduction. And so if you are in a higher tax bracket and you are now lowering your overall income, you are taxed at a lower rate. That is a win when it's a flow through entity and you pay on a personal level. C Corps, have a 21%. So unless you have a state tax, just at a federal level, you're going to continue at that 21%. So the result is lower tax bill, more money in your pocket. That's at the end of the day. The results, will depend on the properties, but you will have more money in your pocket because you've done this forward thinking planification of how do I save money? How do I take advantage of the tax code that's out there, that exists, and actually follow it and be able to obtain a benefit for myself as I invest in real estate. And more cash flow, this means more capital that you can use and put into your next deal, right? Yeah, that's always when real estate investors are looking for what is the next deal. So you've got the one deal, you now have more cash coming out of it because of a lower tax liability, and now you're able to use that cash flow for that, for improvements, or again to acquire another property. So, long-term planning benefits, not just the first year depreciation, right? So we talked about this. I mentioned this kind of briefly earlier. If you have items that are 5 years and you go replacing them over the lifespan of owning this property, you're now taking this item and depreciating it 5 years. And in year 8 or 9, when you replace it again, another 5 years, and you're able to do that every single time that you replace the item. Now, earlier on, I said, well, if you don't do cost segregation, you do 39 years, you've got now an item that you replaced that now becomes a ghost asset. So your things don't look good because your asset tracking isn't really good because you have this asset that no longer exists, but you're still depreciating it over 39 years because you didn't do the cost segregation studies. So it's definitely a benefit of this. There's also simplified treatment. So the renovations, right? If you're renovating and partial disposals. So if you're getting rid of things either before the end of useful life, you don't have to recapture a longer amount of time of that because you've been doing that in a more predictable manner. So it's just overall, it's this predictable long-term depreciation. You understand what your depreciation outlook looks like. Not just from a useful life, but now there's a tax benefit of doing this in year X, of purchasing this new uh, uh, fixtures for your building or making these renovations to your building or to your property that you hadn't maybe considered previously. There's now well, if I do it in year 10, which is really where you want to do it, it might not make as much sense because as we're doing this together, we're coming up with a tax plan and realizing year 9 is going to be a great year for you. And obviously we don't know that far in the future. We're talking about this in year 8 and we're looking forward towards year 9 and we're looking that year 9 is going to be a great year. So we're like, let's pull in those expenses, useful life. We already depreciated it in year 5. Let's go ahead and do this in year 9. Lower our tax liability and begin doing so in year 9 as opposed to year 10, where you will not attain that tax benefit. So I did say I'm going to talk about bonus depreciation, and bonus depreciation is sort of the icing on the cake for cost segregation. They are separate, but they can be combined. And so you may or may not know, bonus depreciation was being decreased and was going to be phased out. You have the Big Beautiful Bill. Because of the Big Beautiful Bill, bonus depreciation is back, and it's back at 100%. And that's for the foreseeable future. And so, as you see here, if you put it in service in 2023, the bonus depreciation was 80%, 24, 60%, 25, 100%. But I put that nice little asterisk. And that's because of the timing of the bill. That's only for properties that were placed into service after January 19th of 2025. So if you closed on January 18th or put into service, I should say, prior to January 19th, you would be ineligible to take advantage of 100%. You would be subject to the 40%. So the real message here is the earlier you do the review, the earlier you perform the cost segregation study, the earlier you understand the overall depreciation picture and what makes sense for you, right? Everything I say here is very generalized because it's at the end of the day, when I sit down with, I could sit down with 2 clients and they have very similar situations, but different objectives. And so we may not want to take advantage of bonus depreciation for person A because they maybe have lower income, even though these next years, so they don't really want to take the bonus depreciation. Whereas other folks may have higher income and that they're trying to offset, and they'd like to have that bonus depreciation hit now. So it's always a very specific to each individual, and I like to kind of tailor these to everyone. But this is I think a good overview, right? The earlier you do this, the better you understand, and then you can then decide is bonus depreciation right for me? Should I wait for bonus depreciation? And what does the future hold? That's the other one, right? No one has a crystal ball. We didn't think bonus depreciation was coming back, and it did. It could also go away again, and so it's anyone's guess when it comes to what the future is. But this is today's picture. This is what we could plan on what's known. All right. So I mentioned a little earlier on. Well, what happens if I place the property into service and I didn't do a cost segregation study? Is that it? Am I out of the picture? Well, not necessarily. There is an opportunity to go back and do retroactive cost segregation. And there's some benefits. Obviously, there's some downsides. So each case will be different, but you can take a property that was placed in the prior years. You can not amend the return, and we could actually take the missed depreciation in the current year. So if it makes sense, this is the year to do it. Let's do that. And so that's part of the work that we do, right? Of working with folks to understand their situation and see what makes sense. They haven't done it, right? And I've met with real estate investors all over the U.S. and some very sophisticated real estate investors, and it surprises me each and every day that they don't work with an accountant that understands real estate and has never told them about cost segregation. In fact, when they went to talk to them, they said, "Oh, it's not worth it. Just go to the county and whatever the county says," right? And so they're missing the mark, because there may be a benefit, there may not, right? But for the most part, if you have income, you want to have as much expenses as you can in order to lower your tax liability. And this is really the vehicle in which to do so. We promised an example. So I'm going to spend a little bit of time on this one. There's a lot of images and things kind of going on. So I'm going to walk you through it. Probably should have put a picture of a building. So imagine a $4 million multifamily building. And if you see the chart on the right, if you like charts, I'll go through the chart real quick. Straight line, the blue line, it just says, if you did that initial pizza slicing in 27 and a half slices, you would have this even depreciation throughout those years, right? So if you're a numbers person like me, so you bought this building, it's a $4 million property. We're assuming for this example, a $600,000 land valuation. So you have a building that's now $3.4 million and for depreciation, right? You cannot depreciate land. And if you do the standard method, which is do nothing, don't do a cost segregation study, you just divide it over 27 and a half years, and you're able to deduct $123,636,000 year one and every year onward. Now, if you flip the script and say, well, I actually want to do a cost segregation study, what's the benefit, right? Well, here we see a pretty good example of a clear benefit, and I'm using here some numbers to tell you that land. If you take land improvements, that parking, fences, landscape, those you can actually depreciate over 15 years. So you get this nice handy dandy cost segregation engineering report that shows you that you had $340,000 worth of land improvements. And now you can justifiably to the IRS depreciate this over 15 years, right? And personal property, right? So we're talking about this multifamily property. You have appliances, you have carpet, you have vinyl, you have cabinets, you have these other items that can be depreciated in a shorter time frame, so at 5 years. So now you can accelerate just over $1 million worth of items that you would have otherwise had to have waited the 27 and a half years to obtain the full benefit. So if you add them up, I promise the 2.38, the 340, the 680, they add up to the 3.4 million. So you have this $3.4 million property that's now being depreciated in a much different way. And instead of year one deduction, 123,000, you're now at over 245,000. So forgetting about bonus depreciation, forget about the things that you could take the 5 years in year one, forgetting about those, If you did this without any bonus depreciation, you would have a $51,000 tax savings or a tax reduction, which is about double what you would have had if, in this example, I'm using a C corporation tax at 21%. You would have about double the savings that you would have had you just done a straight line uh, uh, standard depreciation over the full useful life of this building. So you look at this and you say, well, gee, I have this opportunity now of about $26,000 ends up in your pocket, $25,000 and change. That's extra capital, right? I talked about early on. So you want to lower your tax bill, you want more money in your pocket, you want better cash flow, but then this gives you capital that you can also reinvest or redeploy into other properties, into other projects. So it's not just, hey, I'm saving taxes, but it's also how do I take this and redeploy it into future